when we say financial mathematics, so generally people always have some kind of phobia with mathematics, and all this financial market, is made up of money only. As the current, global environment that, everyone talks about the rate of interest rate, all the fixed income products, whether it is a bond or any debt instruments or even, the insurance, right? The corporate treasury, they all work around the rate of interest only. If you see here, it says 11.02% per annum and 60 months, right? And again, it says effective yield. When we say yield, returns, they connote the same thing. They have the same meaning, right? When you see the word yield, it means return only. Okay, again, if you see, observe here that the rate of interest is going up, right? So if you see this red color advertisement, if it is a 13-month time period, then it is 11% per annum, and up to 60 month or 5 year, it goes up to 12.5%. Again, in the third bullet point, it says the monthly, yearly, and cumulative options. So these are the options given. That means if the investor is looking for monthly payouts, then there is an option of monthly. It can be annual also, and it can be cumulative, means when the bond will mature, then towards the end of the tenor, the lump sum amount will be given. So these are the different options. With every option, the rate differs, right? How this interest rate is made up of. Okay, so we will see the component, the constituents of the rate of interest. So the first component of the interest rate is real risk-free interest rate. When we say risk-free, so what we refer is basically, in a money market instrument, we refer the treasury bill, T-bills we refer, right? In a longer term, when it comes to the debenture bonds, what we refer is the 10-year Government of India bonds. So risk-free, basically the reference become more towards the sovereign securities. Now to that, another component is added, okay, that is known as the inflation premium. So there is always a inflation, right? So those reference point can be whole price index, which is declared by the RBI. So that becomes one of the reference, okay, for the inflation measure. So inflation premium is real risk-free interest rate. In a normal circumstances, when we say, let's say the bank rate, or when we say, what the term deposit rate are, so we are talking more in terms of that, and we are talking more in terms of the NCDs. Okay, so on the NIC website, just say I'll go to the market data, and in the debt and fixed income segment, let's see the securities traded on the exchange. You can see here the symbol, it is 96 IIFL 28, right? That means 9.6% is the coupon rate. Next, you can see the default. There can be default, right? The issuer can default. So there can be default. So that is also added, because there are always some kind of NPAs or default. But then you can see the liquidity premium. When we say listed, they are liquid in nature, but not necessarily liquid are also traded frequently. For instance, if you see, are quite low, but the liquidity is less. And the last one, it says the maturity premium. With more maturity, the rate increase. So if you see the 13 months, it is 11%, but when you go to the 60th month, 60 month time period, it goes to 12.5%. So the longer the maturity, the rate goes up. This is the basics of the rate. We are going to cover, first we'll go with the concept of interest rate, and then, what are the different types of rates, how to convert one rate into another rate, and why it is needed, and all this through the applications.